Assalamu alaikum. Good afternoon. Welcome back. Just we have seen now the ratio analysis and the problems we face in the ratio analysis. After making the financial statement analysis through common size statements and ratio analysis, next is the financial models to be prepared for forecasting uh, the future. We have to forecast. Okay, seeing the performance of 2019, for example, we can forecast the operation for 2020. We can forecast and 2020 and future. For that, um, maybe 15-20 years before what was happening, this forecasting was being done manually. But once the modelings are being used, it became little easier for us. But we have to understand how we do it so that we can easily do it without having much of hassle, and it can be error free. For that, let us understand how we do the forecasting through the financial models or the spreadsheets, how we do it. Let us now understand certain basic assumptions we have to assume here. Number one, the investment in the new assets, that is particularly long term assets. So, this is normally, long term investment decisions are known as capital budgeting decisions. So, that is what uh, plays a very important role while forecasting the future. Degree of financial leverage, that is the capital structure decision. How much should be the borrowed money, how much should be the share capital, or the liability and capital, how much we make a kind of balance, whether we want to keep the same capital structure or we want to increase the debt. So the debt and equity mix we can call capital structure decision is also known as debt and equity mix. So that decision also very important while deciding the future. Third one is the cash paid to the shareholder. As I explained you, this is the dividend policy. For example, in the previous year, in 2019, we have seen that the net income of the company is 363 million. Out of this 363 million, 242 million is kept in the business, 121 million is distributed as dividend. So this is decided, 67% is retained, 33% is paid to the shareholders. This is known as dividend policy. So how much to be distributed to the shareholders and how much should be retained in the business. Liquidity requirements, it is determined by the net working capital decision. The first one is the long term capital budgeting decisions, and the fourth one is liquidity, that is working capital decision making. How much should be your working capital? Your working capital policies should be very much clear, and we should follow to that, whether we want more working capital in future, or with the same working capital, existing working capital, we want to continue our business. So these are the four decisions very important for making the future projection. So first one is the long term investment plan. Second one is the capital structure decision, that is debt equity mix. Third one is the dividend policy. Fourth one is the working capital requirement. These are the four uh, basic pillars on which our financial model stands. So I hope it is clear. The long term decision making, debt equity mix or capital structure decision, the dividend policy, and the working capital policy. These four pillars on which financial models are being constructed. How we do? Many different methods are being followed for the financial planning. The more concrete and more practically, most of the financial analyst uses sales forecast method, which is also done uh, in our forecasting. We have used the sales forecast method. I will show you. In the sales forecast, what we do, uh, we assume here most of the items of the income statement and balance sheet we assume as a percentage of the sales. Again, I'm telling, most of the items we assume as a percentage of the sales, and we try to forecast what will be the sales in the coming year. Here we have forecasted just the 2019 actual sales is 2311, and 2020 forecasted sales will be 2019 sales multiplied by 1 plus growth. Growth we have calculated down using the sustainable growth rate, that is 1 ROE multiplied by RR divided by 1 minus ROE multiplied by RR. I'll explain you growth calculation maybe after few minutes. Here the growth is calculated 10.29%. This 10.29% is used here for forecasting the sales of 2020. So 2020 sales will be, forecasted sales will be 2019 sales multiplied by 1 plus growth will be the 2020 sales. Then all items you can see here, the cost of goods sold 62%. So 2020 cost of goods sold will be 62% of 2020 forecasted sales. Depreciation will be 12% of forecasted sales. Operating income 26% of the forecasted sales. Then EBIT 26% of the forecasted sales. Interest 155, that is 6% of the forecasted sales. Pre-tax income 506% of the 20% of the forecasted sales. Taxes 4% of the forecasted sales, or we can calculate 21% of the pre-tax income. Like that, it becomes easier for us because the sales only we forecasted, taking the growth rate, we have forecasted the sales. After that, each and every item is a percentage of the sales we calculated. That is called sales forecast method. Pro forma statement. That's why we have used the word pro forma income statement. You see here, the name is pro forma income statement. That is forecasted income statement. Pro forma income statement of Prufrock Corporation. Similarly, forecasted balance sheet is named as pro forma balance sheet of Prufrock. That means estimated, forecasted. Here, setting up the plan as projected pro forma, financial statements allow for consistency and ease of interpretation. Everything we interpret as a we first set up our pillars, then we make the projection based on that. Like I showed you, the sales forecast I have explained you right now in the pro forma statement. What we have done, we have just predicted the 2020 sales based on 2019 sales multiplied by 1 plus growth. Then whatever sales came for 2020, all items we have calculated as a percentage of the estimated sales, and we develop the pro forma income statement, pro forma balance sheet based on that. We calculate the asset requirement. I have shown you, again I'll show you. You see, pro forma balance sheet has been developed. How? In the current assets, long term asset, fixed asset, all these things we will take as percentage of the sales. Here we calculated as a percentage of the sales. Here you see, 2018 2019 we calculated the assets as percentage of sales. So the, here you see, percentage of sales, accounts receivable is 4.24% of the sales. We just go to the pro forma balance sheet, we calculate cash 4.24% of the sales. Receivable, how much percentage? Check here, 8.14. Receivable is 8.14% of the sales. Total current liability will be, total current assets will be 18.26%. Similarly, one by one we calculate here the current assets and current liability. You see here, just I'm little, yeah, now you can see. Yeah, The cash and cash equivalent 4.24% of sales. Receivable 8.14% of the sales. Inventories 18.26% of the sales. Total current assets 30% of the sales. Similarly, net property plant 124% of the sales. Total fixed asset 124% of the sales. Total assets 155% of the sales. Simply we have all the kind of inputs. Go to the spreadsheet, the modeling area, cash equivalent, receivable, inventories, total current assets, total property plant, as per the percentage total assets. Now payable also as a percentage of the sales. Payable is 14.89% of the sales. That means almost all items of the asset side as a percentage of the sales, and in the liability side only current liability. Notes payable, you see I have written NA, that means not applicable. Total current liability NA, not applicable. Similarly, long term debt not applicable. Total long term debt not applicable. Total liability not applicable. Then what we will do? How we will project the notes payable? We will keep it as it is. How much was there in 2019? We keep same amount in 2020. Notes payable. Then the total current liability will come. Similarly, long-term debt, we will keep as it is. How much was the total long-term debt in 2019? Same we will keep in 2020. Then total long-term liability. Common stock, same we will keep as it is. How much was there in 2019? We will keep the same amount here. Retained earning, 2019 retained earning plus the retained earning of 2020 we have calculated here. We have calculated here the retained earning of 2020. You see 266.63 million is the retained earning of 2020 estimated. This will be added with the retained earning of 2019. 2019 the retained earning was 2041. 2041 added with 266 will be equal to the retained earning of 2308. Then it becomes total equity. Then your current asset liability plus long term liability plus total equity will be total liability and equity. Now you see our balance sheet identity says assets must be equal to liabilities. So assets is 3157, liabilities equity is 3890. They are mismatching. So there is a shortage of 67 million. That will be known as EFN. So external financing needed. External financing needed. So let us do it, please. So this is the way asset requirements are being projected. All assets normally, if you are doing the sales forecast, all assets are forecasted as a percentage of the sales, as I have shown you. Then financial requirement. I have just shown you financial requirement, EFN. Assets, total assets you project, liabilities and capital also you project, like current liability as a percentage of the sales, other liabilities we keep as it is, and common stock we keep as it is. Retained earning, previous retained earning plus current year's retained earning will be the retained earning of this year plus equity, then it will be total equity. Whatever is the total liability and equity, once you deduct from the total asset, you will get the external financing needed. Then we just plug the variables, as I have shown you how I plugged the variables. Economic assumptions, explicit assumptions about the coming economic environment is very essential, otherwise your model will be not correct. So percentage of sales, as I told you, in percentage of sales approach, what we do, all items of the income statement, almost all items of the asset side of the balance sheet, and the current liability of the liability side we take as a percentage of the sales. Just we have discussed here in the forecasting income statement, pro forma income statement we have seen here, all all items from cost of goods sold to the net income we have calculated as a percentage of the sales. Then we have forecasted the sales for the coming year 2020 in this company Prufak. How we did that? 2019 sales multiplied by 1 plus growth. I will explain you how growth has been calculated in a separate section. So once we finish this, we'll go for the growth. So we calculated growth there. 2019 sales multiplied by 1 plus growth will be the 2020 sales. Once you derive
Doc- Doctor, growth by percentage, right?
growth is 10%. Growth is 10%. That is the sustainable growth rate here, calculated as 10%. Where is that? Okay, you see 10.29%. Okay, so just we used this 10.29% growth, that is sustainable growth rate we used here. We calculated the 2020 sales. Once we got the 2020 sales, all other items we calculated as percentage of the sales. Then we got the net income. Once we got the net income, the dividend policy, you see in the assumption area, one of the pillar is dividend policy. So the dividend policy of the company is very clear to us. In the previous year, dividend policy is 67% retained earning, 33% dividend paid. So 399 net income projected for 2020. Out of that, 67% retained in the business, 33% paid. So this is the way we make the kind of all the items in the income statement. We first projected the sales for 2020, then all other items like costs may vary directly with sales. If this is the case, the profit margin is constant. Depreciation and interest may not vary directly with sales. If this is the case, profit margin is not constant. Dividends are management decision and generally do not vary with sales. This affects addition to retained earning. We have seen here the dividend is as per the dividend policy, not on the basis of sales. Dividend is 67% of the net income is retained earning, 33% of the net income is dividend paid. This is a dividend policy decision, not on it is not affected by any sales amount. So dividend policy is not affected by sales. Same balance sheet. Initially assume all assets including fixed asset vary directly with sales. I have explained you the asset side. We can see here all items of the asset side we are assuming as fixed percentage of the sales, like the cash in hand is 4.24%, receivable 8.14%, inventories 18.26%, total current assets 30.64%, the long term asset 124%, total asset 155%. That means all assets side we are assuming as a percentage of sales. In the liability side, only one item we have assumed as percentage of sales, that is accounts payable. Other items doesn't vary with sales. That's why we kept the wording not applicable. We kept the wording not applicable, and for the other items of the not applicable, you can see here. So the notes payable, total current liability, long-term debt, equity, all these things not applicable. They are not varying directly with sales. The change in the retained earning portion of the equity will come from the dividend decision. You see here, I explained you. Again, I'm just explaining here. The net income forecasted for 2020 is 399 million. Out of that, 133 million is distributed as dividend. 266 million remains in the business. So this will be added with the previous year's retained earning. 2019 retained earning we get from the balance sheet. Here is the accumulated retained earning of 2019. 2041 million added with 2041 million added with 266.63 million will be the retained earning of 2020. So this is the way we calculate the percentage of sales approach. Then assets and liabilities did not match with each other. The difference of assets and liabilities will be the external financing needed. Here, the difference between assets and liability is assets 3,957 million, liabilities 3,890 million. So, the difference between assets and liability is 67 million, that is the external financing needed. This is very elaborately we have done. We forecasted, then we have calculated it. It can be also done through a formula. I will go through that. But before that, I will show you a magic here. For example, where is that income statement? Yeah, 2020 expected. You see, 2020 E stands for 2020 expected. But do you think how I have written this 2020 E? Do you think I have written 2020 and E? No. Why? You can see the in the range here only 2020 is written. I'm not writing the 2020 expected. It is automatically formatted. How we do that? I will show you here. 2021, for example. I have written here. But what I will do, 2021, I will go to the more number formats. Then I will go to the custom formatting and I will go to the 01 and I will write there invented comma. I will write there E and invented clothes. That means whatever I will write there, it will show like this. So you see now what I will do, um, this is equal to this plus 1. See 2020E and I will extend this to control R. So all these things you see estimated now the forecasting came. What I will do here just simply uh, the C171, C34, this is the amount. This will be 4 and okay, now control R. This is okay. Now formatting is clear to all of you. Just a minute, let me maximize. Yeah. So 2020 I just forecasted. The formatting range I just explained you. Once again, I'll just try to explain you. You see 2020 I want to write, for example, this also delete is equal to 2020. Then I will go to the custom range, more number format. You go to the custom one and 0, the first one is 0, click there. Then whatever you want to write, for example, forecasting, F, I will write as F and you will write OK, enter. See 2020 forecast. For the next year formatting, just previous year plus 1 will be the next year. Once you do that, extend this. How many years you want to extend? Control R. It will be automatically taking to the range. So like that. But this is one of the formatting I explained you. But here basically what we have done, 2019 sales was there with us. 2019 income statement was available to us. There we have calculated the common size income statement where we got all the percentage of other items as percentage of sales we calculated. 2019 sales is available. Growth we calculated using the sustainable growth rate. We calculated growth. Then 2020 sales forecasted is equal to 2020 sales forecasted is equal to 2019 sales multiplied by 1 plus growth. 2019 sales multiplied by 2019 sales multiplied by 1 plus growth. 2019 sales multiplied by 1 plus growth will be the 2020 sales. 2020 1 sales is equal to 2020 sales, right? 2020 sales multiplied by 1 plus growth. The growth is here. Just we calculated the growth 10.29, and this one we will write as F4 so that it will be locked. Okay, enter. You see now 2021 sales are being forecasted. Now what we can do, we can extend this up to 2024. We got the sales for 2024. So 1 year I forecasted, then remaining years simply I can just, and this one shift select control R. Okay, so here I can reduce the, yes. So this way we make the forecasting for different years, but the basic thing here is we calculated the balance sheet forecasted for next year, income statement forecasted for next year. How we did that? For the next year sales is equal to current year sales multiplied by 1 plus growth. Once we calculated that, all other items as a percentage of the sales we have calculated for 2021. Income statement has been derived. So same like for balance sheet, what we have done, we have calculated percentage of sales for all the assets. Then we have calculated the forecasted current assets for 2020 as estimated or forecasted. That as a percentage of the sales. In the liability side, accounts payable only we have calculated as percentage of sales. Others we kept it as it is. Notes payable, long-term debt, as of 2019. Stocks, accumulated earning 2019 accumulated earning plus retained earning of 2020. Then we got the total liability and stockholder equity. Then assets became more than the liability. They did not mismatch. The difference we have calculated as external financing needed, that is 67 million. This can also be done by using a formula, we'll see. So the external financing needed can also be calculated using a formula. What is that formula? Total asset divided by total sales multiplied by additional sales minus current liability divided by sales multiplied by additional sales minus profit margin multiplied by new sales multiplied by 1 minus dividend payout ratio. Here 33% for this company, 33% for the company. We have used this formula here down. Just come down here. After calculating the growth, we have used this formula. See this external financing needed through the formula. We can write down here, insert a comment through the formula. Through the formula. Let us check whether we are right or not. We will calculate through the formula. Projected sales or 1 minus D is equal to, the formula is written here. I'll just extend zoom the area. Yeah, you can see total asset divided by total sales multiplied by additional sales minus current liability divided by sales, current liability divided by sales multiplied by again additional sales minus profit margin multiplied by new sales multiplied by 1 minus depreciation. We have all these data in the income statement and balance sheet. We used here, see, the total asset is 3588 million divided by total sales is 2311 million multiplied by the additional sales. Additional sales, how you will calculate? This is the additional sales 237.82. The new sales in 2020 minus additional old sales of 2019. You see, additional sales is here. Additional sales you can calculate here. You see, the original sale is 2311 and projected sale in 2020 is 2548. So 2548 minus 2311 is the additional sales. Hope it is clear. Now let us show you through these figures. So 3588 is the total asset, 2311 is the sales. So asset divided by sales multiplied by additional sales 238.09 minus 344 is the current liability in the balance sheet of 2019 divided by 2311 is the sales of 2019 multiplied by 238.09 is the additional sales minus profit margin of the company. We calculated profit margin here 15.69%. So profit margin 15.65 multiplied by the new sales. New sales is the 2311 original sales plus the additional sales is the new sales multiplied by 1 minus 1 minus payout ratio. Payout ratio is 33%. So the retention ratio 1 minus 33% is equal to 67%. Once we use it, it came 67 million. Here directly using the formula we have calculated here, inserted the function. So total asset divided by total sales multiplied by additional sales minus current liability divided by sales multiplied by additional sales minus profit margin multiplied by new sales multiplied by 1 minus DPR is equal to 67. Interestingly, you see this 67 we calculated through formula. Here this 67 we calculated through the model. You see 67. You can see here 67 is the EFN, asset minus liability, 67 million. So this is the way we make the financial modeling, and this author has calculated the external financing needed for one of the example in the book. You can go through the book, please. Just a minute. Open the McGraw-Hill, please. Open the McGraw-Hill. Sign in. And go to your course and in the library go to the ebook, click there. Okay, go to the content page. It's opening. Yeah, 3.4. Just I went to the chapter 3 financial models. Okay, here is the example taken in the this example has been discussed in the formula. Rosengarten Corporation income statement is given to you, balance sheet is given to you, pro forma income statement taking the original sales is 1000 million, the sales projected is 12.5% is the growth rate. So 250 million will be the new additional sales, so 1250. And using this balance sheet data, the external financing EFN is being calculated. How? Asset divided by sales multiplied by new sales minus current liability divided by spontaneous liability, means current liability. Current liability divided by sales multiplied by new sales minus profit margin multiplied by projected sales multiplied by 1 minus dividend payout ratio. This is being used here to get this 565 million. and they have done it. You can see the difference is 565 million. It is being used as a, so this is the way the percentage of sales and EFN is being calculated, the external financing and growth at low growth level. Yeah, now how the growth and the external financing are linked with each other, that we will see in the, we will just stop the recording here, and we'll stop the recording here. After that, we will see the uh, only growth related discussion we will make then next phase.